So let's give the people from the investor panel a chance to get back into the room from the interesting discussions. We've already heard a lot about digital lending today. We've heard a lot about refinancing, or at least we touched upon those points. There are various different ways in, how platforms can refinance. And actually, we've heard about the Death Valley of missing scale-up funding in Germany, and probably that goes for most of Europe. It's not comparable to what we see in the US. So the next step to that will be actually letting the investors talk. And here we are. So please come up to the stage. You may have spoken to one or the other person already. They've been in the room for a couple of hours already. But let's do a first round of introductions. Conor, would you like to start?
Yeah, happy to. Everyone, my name is Conor Sheehy. I'm from a fund called Viola Credit. Viola Credit is a 3.3 billion alternative asset manager focusing on the innovation economy. We have two strategies. One is growth lending, which is the provision of venture debt facilities sponsored by companies across Europe. And the other strategy, which I'm responsible for in Europe, is asset-backed lending. So financing collateral originated by sponsor-backed originators across Europe. Minimum ticket size is probably around 20 million euros, dollars, pounds, ranging up to 500 million. And yeah, in a previous life, spent a lot of time in the German market financing various different German platforms. So very happy to be here. Thank you.
Okay, then I follow. Hopefully it works. I can hear myself. Yes, my name is Jens Lindner, representing ING. I would not call myself an investor, rather a solution provider. So I have been also an investor in, let's say, Fintech exposure, but primarily got in touch with the Fintech world and digital lending through providing a solution to an, let's say, growing company. And just had an interesting discussion in the break that I believe that asset-backed finance is indeed a perfect tool in the life cycle of a company to help to grow. And ultimately, looking also on the context of this panel, everyone wants to have success, both the lender as well as the growing company.
So my name is Lukas Diehl. I'm from Varengold Bank. Varengold Bank is focused in financing fintechs since 2017. So usually what we're doing, we are not financing fintechs directly, but we try to finance the pool of those fintechs, whether that be in consumer loans, SME loans, or any other type of receivable business. We also supporting other fintechs or startups in the space of asset-based lending, similar to what Conor just said, especially if they are in asset-heavy transactions and need financing solutions for their assets, whether that be cars, smartphones, whatsoever, can be every type of assets that we are financing. And yeah, we're doing that for quite a while now. We're now with the bank expanding also in another segment beside the fintech space, which is energy transition. But the focus still remains on the fintech part. And this is where we want to grow the book going further.
Hi, everyone. I'm Jan. I'm representing Citibank today. We are a global financial institution active in most of the relevant markets worldwide. I'm doing fintech coverage, so I'm covering our relationships with fintechs in Germany, Austria, and also the Benelux market. We are an investor on the equity as well as the debt side. With Citi Ventures, we are quite active in the equity field. With our securitization team, we are providing large ABS transactions to fintechs to refinance receivables pools. But besides that, we are also an infrastructure provider, so we can also provide infrastructure that platforms need to handle payments, to do collections, and so on. Also everything around FX. So we are a global solution provider that rather steps in at a later growth stage, I would say.
So as you've heard, we have a quite diverse panel. So we have banks, we have large investment banks, we have specialized banks and private credit on stage. So in case you have any questions after this panel, please note them down now and ask them at the end. All of them have worked with platforms before and helped refinancing them, enabling solutions and enabling the growth of those platforms. My first question to you would be, what is actually the most remarkable development that you've seen in recent years in that space? Maybe, Jan, if you want to continue on that one.
Yeah, happy to do so. So I would say the most remarkable development we have seen in the space is the development of the platforms themselves. So we have seen many coming from early days, being also less professional, very much focused on equity raising, but not so much on the debt part, developing into very professional organizations, having people on the ground who are really able to steer the refinancing process with debt providers, because a debt provider is looking at it completely different, more into the receivable rules, versus an equity investor is more looking into the growth story. And these more mature platforms are now really able to attract scalable debt facilities, which help them to grow their business going forward.
So what we realized over the last years, more or less, especially in Germany, given the fact that the German regulator doesn't want to see any fronting banks going forward, I think that is a big challenge for particularly the German market, because there aren't so many other solutions around how alternative lenders could provide lending, especially in the German market. It's currently a very tricky situation that we're facing, especially in this market here. But also what we see in other markets, that there is a huge consolidation taking place from maybe platforms that have not developed as they may or have thought they could do. And therefore they now merge together with others, join forces to become larger platforms and then have better negotiation power also with us or larger banks to may reduce funding costs. And maybe at one point in time, and that is, I think, one of the biggest challenges all the alternative lenders are facing. They want to become more equity light going forward. And to be able to do that, they need to provide sufficient data that they could attract lower advance or higher advance rates, or even find mezzanine funding that helps them to grow the book further without always injecting fresh equity when they want to grow the book.
Yeah, I would love to summarize the development actually in 2 words. It's maturity and coexistence. Let me explain. So coexistence, we come from times 2015, 2016, everyone was talking about, primarily also from the industry themselves, disruptive force. And then, of course, senior levels in banks got a bit concerned. No one wanted to talk to each other. But finally, we see actually a good relationship. Yeah. If you take the word fintech, and to me, it's actually the focus on technology. It's a evolution of process innovations rather than product innovations. That also showed to banks, okay, yes, they have a benefit. They have the latest technology. They have not, let's say, legacy systems. That helped a lot. On the other hand, there are also 2 elements where the new and the old world come together. It's the regulation as well as the refinancing need. So this actually had the benefit, or a situation where both worlds need to act with each other. What contributed to this, let's say, peaceful coexistence is in fact the maturity of the fintech industry. Jan already mentioned we see more professionalism. We see often also successful business models where equity is growing and no need to recycle equity with new funding rounds. There are also established financing relationships, but also the regulation just mentioned it, becomes, of course, fairer, maybe. We never had a sandbox model in Germany, but at least what you mentioned, whenever you do similar business as all the incumbents already do, there is the same regulatory treatment. And I think this is probably also a good level of fairness that helps, let's say, existing financial service providers, fosters the peaceful coexistence. But overall, I see, and this is really the remarkable development, professionalism in risk management, in data provisions, the way also how the front office business is made. It's not only focused on the minimum viable product and quick increase in sales. No, there's more in a drive to quality.
I think the team here had it covered pretty well. I think, from our perspective, just a lot of what has been said already. So definitely seeing a wave of consolidation. There are a number of businesses in Europe and the UK that are trading right now. I think, I don't know if there's a huge amount of commonality in terms of the problem set that they faced, other than what tends to be uniform is a lot of these companies tend to underestimate the challenge of actually originating and distributing. So actually having innovation on the product side, which doesn't come across all that often, is pretty novel, but it isn't necessarily enough to grow a business. Doing something interesting on the underwriting side, again, is great, but if you can't kind of define or identify a proprietary origination channel for that business, it tends to be pretty problematic. Seeing a lot of German platforms now looking to raise finance using different methods other than funding banks. So novel methods coming here, which are really interesting. And I think seeing on the maturation of the fintech side, seeing a lot of companies placing more of an emphasis of getting the right people, so people with experience on the product, the operational, and the credit side to expand their business, which is good to see.
Yeah, so I think when Jens mentioned mature markets and platforms becoming more mature, becoming more professional, we all nodded on our break call, so there's quite some consensus on that on this channel at least. So how would you view that from an investor's perspective? I mean, probably professionalism is always a good thing, in particular if you're a bank investor. How about new players coming to the market? Do you think it has become more difficult for them also to attract capital?
I think. Look, there's always capital out there chasing good opportunities. So that's everyone just needs to accept that. I think what has become maybe more of a challenge to overcome on the equity side, I think it's been difficult for equity investors to realize returns on pure lending businesses. So there haven't been a huge number of success stories on that side. So on the equity capital side, it makes it a little bit challenging. Also, the universe of investors that really understand these balance sheet intensive business is not that large either. So it's difficult to connect to the correct source of capital on the equity side. And then on the debt side, I think there's still an active market there on the fund side, and also the banks. I think it's often the place where a credit fund come in and finance an originator that doesn't have the performance track record that a bank might be looking for. But I think across the investor set, people are definitely looking for, companies that understand the product, understand the market, but also understand some of the more maybe technical aspects in terms of the regulation landscape, how to mitigate risks in fraud in particular, which has reared its ugly head in on this side of the pond and also in the US quite recently.
100% agreement. Would add that there's always a competition. If you have capital, there are several alternatives, and with increasing yields in the last years, roaring stock markets globally, there were other alternatives. And what you exactly said,
in particular in the fintech world, you have capital-intensive business models, and that is something equity typically don't like in terms of fast returns. So probably the money moved a bit away also from, let's say, unpleasant lessons learned, where capital was heavily burned. So I think there is also a maturity from the equity investor side to see, okay, where do I want to play and why? There are alternative sources, in particular when you have capital needs for funding, refinancing. Debt funds is a growing, say, a source of that refi capacity, so that there might be also a more professional capital structure in this new type or new businesses, where you really have an idea, okay, for what is equity and for what is other sources of capital.
There's nothing to add in addition, but what two guys mentioned, I mean, the major constraint is still on the equity side, and that's why we see those movements from platforms to get away from or warehouse kind of facilities and try to get forward flow agreements in place or even go to a fund setup. But then the question is, okay, are there sufficient or enough players around there who will support it from the debt side? So I think that is one of the biggest challenge for sure, from a fintech's point of view and also from the investor's point of view. The less equity they have to spend and could invest into grow instead of just ramping up the book makes a huge difference.
Yeah, and I would also add to that, if you look at it from the equity side, I think a lot of VCs at the moment are looking for SaaS models, so asset light, while still I think there's a lot of attractiveness in alternative lending models because the margin can be much higher. But the problem is there's a lot of VCs who don't understand really these models. And at the same time, I think you need to have a differentiating factor if you come in as a new platform at the moment. So I guess if you're starting the next plain vanilla B2B buy now pay later business, it's going to be a bit difficult for you to attract funding. But we are seeing interesting stuff in niche markets. So for example, if you want to finance the working capital, the gap in the marketing Google affiliate value chain, where you also have the working capital gap, or you really find a good way on how to embed into large platforms, for example, financing the large mobility platforms and how drivers there would be financing vehicles, while it's still very difficult, of course, to embed with platforms. So that's where we see where still some new companies are coming up, but I agree it's quite difficult at the moment to attract funding in that space.
When a platform comes to you looking for financing, and you're generally hooked, you think you might be wanting to invest, there are the traditional risks that you will be looking at, I imagine, like liquidity risks, general operational risks within the company. Are there any additional risks points that you have started considering rather in the recent years or months and that have developed maybe also as part of technical evolution in that sense?
Yeah, probably from a debt or asset-backed funding side, as you already mentioned, would not call them traditional risk. But if you decompose a structured finance funding tool into the asset part, which has definitely credit risk, that's we are here about talking digital lending. So there is definitely credit risk. I think there are ways how to analyze it, to look at it, getting comfortable. But what Conor already said, operational risk, I would not say that's traditional, but there's a particular view on operational risk in, let's say, in a fintech space. Fraud is related between operations and asset. So in the worst case, it happened that no asset is there at all because it was all fraudulent. That's probably the worst case. But where we have been concerned in the past most is indeed the stability of the originator/servicer. So what would happen, and you have to more consciously think about it when you start engaging with such a company. what would happen if this company is not surviving, if there is not sufficient equity coming in the next year. And this faces, of course, complex challenges on the really operational things, so who is doing what when, but also on the legal question, can I draft already now a contract where I oblige a party going forward in an uncertain future to step in if I need them. I think this is probably the particularity, while the asset analysis is similar to traditional and more established industries. Hopefully the data situation is as comfortable as in traditional business models. Now with the passage of time, we see more data points which make it easier to analyze such newly originated pools. But from my experience, a particular focus needs to be taken on the operational side of the whole infrastructure and risk perspective.
Yeah, from our side, as we are serving platforms also in a very early stage, I think one of the key elements that ops risk perspective, that's why we always want to see backup services structures in place in case something happens to the servicer or the originator, that we are able to recover at least what we have out on our portfolio. And I think another risk that I'm currently seeing is especially for those platforms in the embedded financing space, if they interact with a marketplace, for example, and have agreements in place where they have a certain acceptance rate in place, which they have to fulfill. I think that is also a risk where we get a bit nervous because we want to see that proper risk assessment is taking place, and it's not because of the wish of the marketplace we allow that this client will be accepted just to meet the KPIs. I think that is something, especially for the embedded finance platforms, that we look into very carefully.
Yeah, and I would add security structure. So meaning if there usually you would have a SPV in place in Luxembourg and different senior lenders would be purchasing receivables from that SPV. And we usually come in at a later stage. So usually there's already another existing senior lender. And we see quite a fragmented landscape of security structures that are in place, and they could quite differ from the requirements that we would have from a security perspective. For example, accounting of specific SPV compartments to one senior lender. So I think it's very crucial when you're coming to a scenario where you have several senior lenders to really kind of harmonize your security structure that's in place.
In particular, if it's different financings and you already have a security package in place and there's nothing left for the new lender stepping in, so an agreement needs to be found there. Yeah, that's something we're also seeing quite often. We've already talked about SaaS companies. I mean, there are others in the market who are not genuine fintech companies, but rather are, let's say, more in the market of selling goods, providing services, doing something else which is not fintech related, but are deciding to offer some sort of financing product. Is that, how do you view that from an investor's perspective? I mean, it's not, let's say, the core competency probably of the platform. Is that an issue?
Yeah, maybe I can start with it. So we have seen that with some bigger companies who are active in a specific space, and let's say a software company that discovers a specific working capital need, and they have the idea, of course, of financing that working capital need as a new business line. And they might be able also to attract good funding because they already have a good name in the market. But we have seen also some examples where these companies fail on that because adding a financing business to your normal SaaS business can be quite challenging. So I think this is also a great chance for smaller platforms to embed with these companies and pitch for their business because they have the people and the experience to establish such a refinancing.
I personally really like those type of opportunities. So because it kind of overcomes the problem I outlined originally in terms of the how do you originate. So by and large, these companies will already have a customer set to market this credit product to. And also like lots of ancillary non-traditional data around those companies to help the underwriting process. I think the key challenge, as alluded to already, is, is this a bet they're willing to invest in? So are they willing to hire the right people and the processes to extend this credit in the appropriate way? And lots of examples where companies had started lending, established companies generating tens, 100 millions worth of revenue and start a lending business on the side as a side project. Invariably that won't work out all that well unless they're willing to commit to the effort.
I'm more on Conor's side. If there's an opportunity, let's look into that. But use your available equity first, show that it works, and show that you understand what you do. And then you can seek refinancing.
Was having the right people on the spot to help them analyzing the credit risk and we get as cures.
True indeed. We've got quite a lot already on private credit. In particular, our keynote touched on that topic. So it's a topic that we don't want to spare on this panel equally. So do we think there is need in particular in Germany for private credit investments? I mean, Germany is usually perceived as a quite, let's say, overbanked market to a certain extent. Do we think there's an actual need? And are there any particular differences, maybe expanding on those that we've already touched upon, that would differentiate a bank investor from a private credit investor? So many volunteers.
Yeah. Let's start with the bank. Definitely. We need private credit. The risk appetite is completely different. The regulation is a burden for, let's say, banks, for regulated financial investors. Private credit has still the, let's say, the freedom to do things banks cannot do in an efficient way, in a commercially efficient way. I think this is the major difference. We see that, and this has nothing to do with digital lending, but we see that across the securitization spectrum, that there are increasing interest from private credit coming in this what we call subordinated tranches, or with a higher risk profile. There is incredible amount of money flowing in from overseas into the European market. But I also know that there is sufficient capital in Europe, and this is probably one of the political aspects in this context, how to get this available funds materialized or mobilized to also accept higher risk. When we talk about a German, in particular German family business, they invest typically in company shares, private companies, not necessarily public ones. So they take a kind of equity risk. But why is there not yet, let's say, a huge amount of investment flowing really in this element, private credit? We only see it typically in a form of debt funds, where typically institutional investors provide money via that route. But this real, let's say, private debt provisions in Germany, I think, is still a bit limited and has also probably something to do with the culture we still have.
And I think in addition, not only the cultural topic, it's also because of the banking lending space here in Germany, with having 1,700 banks around here. There is less room for private credit. If I compare that to other markets like the UK or the Dutch market, for example, where you only have a few high street banks covering those markets, then there's for sure a huge amount of private credit that can be taken from those players.
Yeah, and I think if we look only at fintech and the platforms, we already see quite some, especially UK-based debt funds or like Viola Israeli-based debt funds deploying capital there. We see it also a lot when we do ABS transactions, for example, in the mezzanine piece that we would be partnering up with a debt fund. But I think it also goes back to a previous panel on regulation. I personally would love to see more real private debt funds here in Germany, but I think regulation is just better in other markets to deploy capital from there to Germany.
Yeah, I think unsurprisingly, I'm going to agree with my panelists, and there's a need for private credit funds to be active in the German market. I think, as everyone's alluded to here, the relationship is largely symbiotic. So there is a time in a company's life where, arguably a credit fund is just a better partner for that company at that stage of evolution. And I think, having recently worked in the bank, I had a sense for the differences. But I had with just one interesting anecdote, I had dinner with the CEO of a German platform, which is no longer active, unfortunately. But they had financing from a credit fund, and he was explaining that they needed to bridge to an equity round, which was due to close in 3 or 4 weeks' time. They had to make payroll at the end of the month, so they called up their lender, and they were able to increase their advance rate on the warehouse from, let's call it 85% to 99%, release a lot of money from the facility. They managed to make payroll, and then the borrowing base was reset the following month. But, I was just thinking, the ability to achieve something like that at a bank, it's not even a 2-month conversation. It just probably wouldn't happen at all. So, there's plenty of platforms I've spoken to over the years where, I've certainly advocated that they take money not from a bank, but from a credit fund whilst I worked in the banking system, because I just knew that a credit fund would provide them with the flexibility required at that time.
Probably a difficult one for committees. What would be, and that's probably the value add for the platform sitting in our audience, what will be your top tips for any platform that is looking into refinancing options, and in particular on the asset-based side?
I would say make debt funding as important to you as equity funding. For example, having, if possible, even the CEO involved and knowledgeable in that topic. Start hiring the right people from the beginning on. So, for example, get a CFO who has done several facilities before and make them kind of equal in the management board. And from first day on, start collecting reliable data, because you often see the issue of non-reliable data, and that can be a breaking point in any kind of debt financing process.
I would summarize it in a single word: empathy. So think like your potential debt provider thinks, and that added to say all the details, data, really from the origination to the back end when the debt provider asks for data. So this helps a lot. I've seen last minute actions actually when debt was needed, and then suddenly people started collecting data. Sometimes they are available, sometimes not, and it's really that a gap from the origination process. And maybe another experience topic: do good things, but write about it. It's not only data, but it's also documented processes. Bankers or debt providers in general, because they have a different, say, cash flow profile. Also, they don't get the upside. They only get what they loan to you and get a yield for it. So they are more risk averse than an equity provider. They also like to see that processes are well thought through, that you act on that and you have documented it. That helps a lot, also convincing your conversation partner or convincing the people behind your conversation partner. He has to turn the back, go to the credit department, whether it's a debt fund or a bank, that say, look, they have data, we like the model, we like the product, but they also have written down and documented what they do, and actually they also follow it. Yeah, this is definitely helpful.
Yeah, I'd agree with everything. Just try and be as transparent as possible. Having the right people on the side of the table helps. There's Jan's point on the CFO is a good one. And I think, hiring the right person with the right skill set, we were talking about before, some of these people are a diamond in the rough and quite difficult to hire and can be pretty expensive. But there are people who've carved out niches as being kind of specialist advisors for these type of financings or fractional CFOs, which is a good way just to bring in that expertise for the period of time that you need to get certainly your first facility.
There is nothing to add on the 3 points.
Do we have any questions from the audience?
Actually, I do. Conor, you said something about Jolly platforms going, say, new ways in order to secure financing, which do not involve fronting. Can you elaborate on that?
Yeah, sure. And some of the panelists here might be actually a better place to describe the technicalities, but we've certainly seen a number of German platforms establish fund structures to originate assets. And then from a financing perspective, it's a little different than your traditional warehouse or securitization structure, where you establish an SPV that is our ultimate end borrower, but that becomes an LP to the German credit fund. So that's certainly one. Well, I've seen that set up for a number of transactions, but I don't know if anyone else has anything to add.
Similar as you just described, we also see some funds in Germany or in Luxembourg and trying to passport and try to directly originate within the portfolio of the fund. And then the question is, how is funding coming into the fund? That's then the key question. There is one way you just described. There may be other ways, as the fund may also receive direct leverage. So that can mean alternative yield. But these are the workarounds that we currently see.
We probably have to say that doesn't cover the entire market because it's a solution for B2B, but for regulatory purposes, not a solution for B2C. Any other questions? Then we'll no longer be standing between you and the lunch break. So thanks very much to the panel. Thanks very much to the audience. It was a pleasure having you.
Thank you.